how I, as a tax strategist for over 5 decades, help retirees convert 40 to 60% of their retirement income to tax-free. In this episode, I'm going to give you insights into how we have helped thousands of Americans at retirement, because at retirement planning is something totally different than what you did for your retirement, like stocking away money in IRAs or 401ks, thinking you were going to be in a lower tax bracket. No. I developed a strategy called a strategic rollout. So I'm going to explain that in this episode and show you how we've helped many Americans convert 40 to 60% or even 100% of their retirement income to be totally income tax free. The IRS knows they're receiving it, but there's nowhere on a 1040 tax return to put it because it's tax free. So get ready. I'm Doug Andrew. I've been a retirement planning specialist and a tax strategist now for north of 5 decades, helping thousands of Americans prepare for a comfortable retirement and not outlive their money. The problem that I've seen is that so many Americans get duped into putting money into tax-deferred IRAs or 401ks. In fact, 91% of Americans, that's what they choose to do. And they're usually told, defer to some future perceived unknown advantage because you'll likely be in a lower tax bracket when you get to retirement. Folks, that has not been true or axiomatic now for more than 30 years. Most savers in America are not in lower tax brackets. If you're watching this right now and you're going, I don't understand this, it's because you probably are not in that income category. Most savers who save seriously and want to have the same lifestyle or a better lifestyle during their golden years, they save 15, 20, 25, 30% of their income. I have some clients that save 60 to 80% of their income, but they have good incomes to be able to do that. Now, those people are not going to be in lower tax brackets when they retire. And there's a lot of Americans that actually are going down the highway with one foot on the gas pedal and the other foot on the brake pedal, and they don't know they're doing it. They're putting money in tax-deferred accounts like IRAs or 401ks, the foot on the gas. But the foot on the brake is they're killing their tax deductions by paying off their mortgages the wrong way and killing their tax deduction. And during retirement, they're not contributing money to IRAs or 401ks. They don't have those deductions anymore. If they were a business owner and they sold their business, they don't have those deductions anymore. The kids are gone. If they move back in as adults, you can't deduct them anymore. And because of irresponsible government spending, we usually agree that taxes in the future will likely be higher, okay? So in this episode, let's dive into how I've helped many, many people convert 40 to 60% of their retirement income, or even more, to totally tax-free income and why. So here we go. Most Americans will draw income during retirement if they've saved money from 1, 2, or 3, or all 4 of these sources. The first would be investment income, the most common. Other people, they have real estate and they get rental income. Others have a guaranteed income like Social Security, they deem as guaranteed income. Don't know if that's really as guaranteed as we think it is, but maybe a school teacher's pension or what have you, or a police officer, or a firefighter. But the most underutilized is the green one, tax-free income. And I just go, why? It's because most people are not educated on how to utilize the tax-free one. So I'm going to convert these 2 buckets. The purple bucket is the most common. It's where Americans have money in yet to be taxed IRAs or 401ks invested where? Usually in the volatile stock market. And they don't realize that Wall Street was not designed to create predictable income. Okay, if you ask your broker when's the best time to sell my stocks or mutual fund shares, they will say never. Well, that's why if you ask an asset manager who has your money invested in the market to give you an illustration of an income, they are very hesitant to do it because most of the broker dealers will say, don't you ever illustrate more than a 4% payout. Why? Now that's pretty pathetic. 4%? And here they are out there touting, you make more money when you have your money in the market. In actuality, Dalbar, who studies investor behavior, says that most Americans who have money in the market during their golden years are only averaging 3.49%, 3.5%. Why? If you bought and held, you would probably average 9. and net maybe 6% after tax. Okay, $1 million nest egg, you should be able to pull out 90 grand a year. You'll pay tax between federal and state tax as high as maybe a third to net 60,000 or 5,000 a month. But most Americans that are retired are not earning that on their IRAs or 401ks in the market. They're earning 3.5% because they have, let's go back to this $1 million nest egg example. If they see their $1 million nest egg go down in value down to 600,000 or 700,000, like it did in March of 2020 due to COVID-19, or after the 9/11 terrorist attacks in 2001, or 2008 during the mortgage meltdown, when they see that $1 million go down to 600,000, they panic and they say enough already, and they sell. They liquidate, they sell low, and then they wait till the market comes back, and then they buy back in high. So Dalbar says the average retired American is only earning 3.5%. So the financial services industry came out with what is called the 4% rule. They only want you to pull out 4% of your nest egg because you're only earning 3.5%. And if you pull out 4, you're going to slowly deplete your nest egg, but not before your LE. LE is your life expectancy. That's called the 4% rule, which is pretty pathetic to me, okay? That means $1 million nest egg, they only want you to pull out $40,000 a year. That's ridiculous. I can pull out double that, $80,000 a year, easily tax-free. You pull out $40,000 out of an IRA or 401k, even in a 25% tax bracket, you're only netting $30,000 to buy gas, groceries, prescriptions, and the golf green fees. In actuality, out of my favorite vehicle, a max-funded IUL, $1 million nest egg can generate $90,000 a year of tax-free income. How much more is $90,000 than $30,000 out of the same $1 million nest egg? It's 300% more. It's triple. Okay, this is huge. What I'm going to show you in this episode is not a little bit better. It's often double, triple, or quadruple. Okay, so this is where 91% of Americans have their retirement resources. Now, there are others who own real estate. And so they've been acquiring this real estate and doing 1031 exchanges and continuing to buy more and more properties, and they get this rental income. They think that their retirement is going to be subsidized by rental income, okay, until those rental properties go vacant or they get burned down in a fire or they get destroyed in an earthquake or a flood. And they have not watched some of my episodes on how you can continue to make money on your rental properties, even if they've been burned down in a fire until you rebuild them. You can still be making money on vacant properties. And a lot of people don't understand how to do that. Please search my video on this channel to see how. But a lot of people think that they're going to get rental income, but they are sick and tired of being a landlord, taking out the trash, fixing toilets, evicting tenants. They wish they could get out of that. If they turn it over to a management company, I've heard horror stories of how those management companies have run the property into the ground and even embezzled money and so forth. I've seen it happen over and over and again. So I help these people. Now, some people like guaranteed income. Social Security, they deem as guaranteed income because it's backed by the government, right? A school teacher pension, a police officer, a firefighter. Some people like annuities. They're not so concerned about being rich. They just don't want to be, poor. So they want a guaranteed income, even if the return isn't that great. That's okay, based on your risk tolerance. But the most underutilized is the green bucket, okay? Tax-free income. Now, Roths would be here, but I've never owned a Roth, IRA or 401k, never will. I've never owned a regular IRA or 401k, never will, because my favorite vehicle, a property structured max-funded IUL, knocks the socks off of IRAs or 401ks and Roths. Why? Because Roths only have two basic advantages. You fund a Roth with after-tax dollars, but it accumulates tax-free, and you can access the money tax-free because you've already paid the tax on the front end, okay? Now, those two benefits have been true with a max-funded IUL, max-funded tax advantage insurance. That's a laser fund when it's structured correctly. That's my favorite vehicle that I'm talking about here. It's been tax-free for over a century in the Internal Revenue Code. Roths have only been around since 1997. So max-funded insurance has the two benefits Roths have, but 4 additional benefits the Roths will never have. So why would I mess around with a Roth? Because I can knock the socks off of a Roth with max-funded IUL. See, I can put in $300,000 a year into a max funded IUL. I can't put that much money into a Roth. If I make too much money, I can't even own a Roth. That's why savvy CPAs and tax attorneys refer to a laser fund as the rich person's Roth. Okay, but you don't have to be rich to have one. You can set up an IUL for $500 a month. But I can put money into an IUL laser fund, and if I put in $300,000 in a given year, and I need some money back for an investment opportunity, 90 days later, I can access up to 94% of that $300,000 with electronic funds transfer or phone call if I need it. You can't touch the money in a Roth without triggering tax and a penalty for 5 years or till you're age 59 and a half. And you can't even put that much money into a Roth unless it's a one-time rollover from traditional IRAs or 401ks. But I get to use indexing with IUL. That's where when the market does well, I get to participate and I get credited 9%, 12%, 25%, 61%, 158%. Yes. If you don't know how to do that, you need to watch the episodes on this channel because our clients average between 11 and 14% by diversifying and rebalancing. And we post these actual IUL statements, annual statements, on the internet under IULperformancewatch.com. Okay. And so max funded tax advantage insurance contracts, I get to use indexing, and if the market crashes, I don't lose. If my money's up here in the market in the purple bucket, I will lose. Now, also Roths don't blossom when you die. What do I mean? If I died tomorrow in an accident, every million I would have in my IULs would blossom to as much as 2 million overnight and transferred tax-free, 2 million to my spouse, to my heirs, to a church, a charity, okay? It doesn't matter, whoever I choose to leave it to. There's not an IRA or 401k or a Roth around that will do that. And people say, how much does that cost, Mr. Andrew? Well, nothing's free, but it doesn't cost me anything, okay? And so you can learn about that here on this channel. Now, what I'm talking about is I recommend that most Americans do a strategic rollout, especially after age 59 and a half when they avoid a 10% penalty, and get the money rolled out of the purple bucket down here to the green. Get the taxes over and done with because your current tax bracket is likely the lowest bracket you will ever be in. And I'm going to show you that here in a few minutes on this episode, that you can do a strategic rollout, get the taxes over and done with at today's lower tax rates, and then put the money into something tax-free from now on. Now, most CPAs and tax attorneys say, well, why would you take money out of the purple bucket, out of your IRAs, if you don't need the money because you're going to pay tax and then put it where? Into something taxable like a bank or a credit union? No, you put it in something tax-free from now on. But see, the IUL actually reimburses me for any of the taxes I pay during the rollout when I pass away. So our family's not out anything because it blossoms in value and reimburses us for the tax. If you don't understand that, you're going to miss out. Okay. So how do we do this? I recommend at retirement, because at retirement planning is something totally different than what you did for retirement. If you save most of your money in IRAs or 401ks, don't leave it there. I recommend no more than 30% of your income at retirement should come out of that purple bucket. I don't care how your real estate's doing. If you want to hang on to it and continue to be a landlord, I recommend no more than 30% of your income in that blue bucket should be reliant on you having tenants. I want you to have income out of your real estate, even if it's vacant. And if you don't know how to do that, you need to search my YouTube title of that, how to earn money on vacant real estate. Or you need to sell it. You need to just bite the bullet, sell it, pay the capital gain, and take the net and put it in the green bucket. And people are shocked when this is generating as much or more income as the rental income was after tax. And they don't have to be a landlord anymore. Okay. I recommend between 0 to 80% of your income could come from the orange bucket based on your risk tolerance. But I recommend that 40 to 60% of a retiree's income should be totally tax-free. Not even show up on the front page of your 1040 tax return. We've done this for thousands of clients, but we do have some clients that say, well, can I get 80 or 100% of my income tax-free? Yeah. I have an episode on this channel where a California couple, they went from the highest tax bracket in California to a 0% tax bracket. They now have $8 million in their IULs, their max funded tax advantage laser funds, they have 4 of them, generating $800,000 a year of tax-free income. They're in a 0% tax bracket now. So this is called a strategic rollout. Now, why is it tax-free in an IUL? Ever since 1986, that was Ronald Reagan's second term, he passed the 1986 Tax Reform Act. Ever since then, there's only 3 types of income Americans pay income tax on: earned, passive, portfolio income. Earned income would be like salaries and wages, okay? That's sort of a no-brainer. Passive income would be income you get from rents, leases on properties or equipment or whatever. Portfolio income is like the interest and dividends you receive from your investments and what have you, okay? Now, if you have income that is not one of these 3, there's nowhere on a 1040 tax return to put it, okay? Yeah, you could have capital gains. That's not earned income or passive or portfolio income. So money out of an IUL is not earned passive or portfolio income. That's why it's tax-free. The IRS knows you're receiving the money out of an IUL. They know everything, but they know it's not taxable, and it's been a sacred tax-free cash cow in the Internal Revenue Code for over a century. It's not even worth auditing because it's never been taxable. It's that simple. Now, as we go to this, on this channel, I have posted videos that illustrate how we've done strategic rollouts for 2 school teachers, and I saved them $250,000, okay, and doubled their retirement income. How we took a real estate landlord and saved him $250,000, but we quadrupled his income from taking RMDs out of his IRAs and 401ks, where he had $600,000. He was only netting $16,000 a year in a 4% payout after tax. We quadrupled that to over 65, even 75,000 of tax-free income. Quadrupled his income. We do this all the time. We have an episode where we talk about a husband and wife, both physicians. We saved them $1.2 million of unnecessary tax. That in IULs is generating $100,000 a year of tax-free cash flow the rest of their lives, with money that would otherwise have gone down the drain in unnecessary tax because they had $4.6 million accumulated in IRAs and 401ks. We took a California couple from the highest tax bracket to a 0% bracket. They wanted 100% of their income. So they had $6 million in IRAs and 401ks. They bit the bullet, paid $2 million in tax over 5 years, netted $4 million into their IUL. That $4 million doubled in 7.5 years to $8 million. They have $8 million generating $800,000 a year, 10%. They don't need $800,000 a year, so they only take out $300,000 tax-free, but they're in a 0% tax bracket. Their money is growing $500,000 a year more than they're taking out. That's what we can do. So folks, we took one couple who had $2.6 million in their IRAs or 401ks, and they were calculating that they could take out 6% a year. So that's about $160,000. So they were planning on $160,000 a year of portfolio income. On top of that, they had another $40,000 coming from a school teacher pension or something. So $200,000 of taxable income. You know, that's pretty good. Most Americans do not save $2.5 million. They're in the top 0.5% of Americans. But the big problem I pointed out, it's all showing up on the front page of their 1040 tax return. They didn't know there was another way. If they had continued to follow the herd, keeping their money in IRAs or 401ks, their advisor would have said, don't pull out 6%, only pull out 4%, which is pathetic. They were going to pay $54,000 a year or more the rest of their life in tax. They only netted $146,000 to buy gas, groceries, prescriptions, and golf green fees. Now, in 5 years, we converted $120,000, 60% of this, to tax-free income, okay? They still had the same $200,000 of income, but 60% of it's now tax-free. They only have to pay tax of $21,600. They now have $178,400 a year, an extra $32,400 a year of money to use. What could you do with an extra $32,000 a year? We will have saved them between $800,000 to $1 million of unnecessary tax because we did a strategic rollout. You need to check this out, and I'll show you here in just a moment how you can have an appointment to talk to a professional. There's only about 13 out of over 5,000 advisors I've trained that I trust will show you how to do this correctly as a tax strategist. What they do is they look at the current year's tax threshold. So let me give you an example. In the year 2025, which is the year I'm recording this episode, we have married couples filing a joint tax return. There's thresholds for single tax filers. But a married couple, taxable income after all your deductions and so forth, between $96,950 and $206,000, that's $109,750 of room that you pay only 22% tax, okay? Because as of the recording of this episode, these tax rates that were going to be increasing by as much as 16.66% had the 2017 tax cuts by Trump not been extended, it was going to jump by that much. But now we know that the tax rate of 22% is going to hold probably for the remainder of Trump's term. So this is an opportunity. If you have a taxable income anywhere between $96,000 and $206,000, the difference between your taxable income and the full $206,000 is how much you could pull out of an IRA or 401k. If you're over age 59 and a half, this should be a no-brainer, and pay the lowest tax rate you will ever be in, and then reposition it as something tax-free. If a married couple has a taxable income between $206,000 and $394,000, that's $187,900 of room. If your taxable income is $250,000, okay, then you have room for nearly $140,000. If you don't use that room, you lose it. Where you could pay only 24% in tax, I probably can guarantee you'll never be in a lower bracket than that if you have that much money. And so you get the taxes over and done with at 24%, because 24% was going to jump up to 28. People say, well, that's only 4% more. No, it isn't. It's 16.66% more money. If you're paying $240 on every $1,000 of taxable income, and now you have to pay $40 more, $40 is 16.66% more than the $240 if you have to now pay $280. That's what was going to happen if the Trump tax cuts expired or sunsetted at the end of the year 2025. And a lot of people don't understand this. But as a tax strategist, I help people use room in these tax brackets that if they don't use it, they're going to lose it, to get money out of their IRAs or 401ks, get the taxes over and done with sooner than later, but then take that after-tax money and put it into something that's going to be tax-free from now on. What is tax-free? A property structured max-funded IUL. If it is, it's called a laser fund. And laser is an acronym that stands for liquid assets safely earning returns. So this is what I would ask you to do. First of all, if you want to learn more, this is our most recent best-selling book that's been flying off of our warehouse shelves. We send out thousands of these a month, and it retails on Amazon for anywhere from $20 up to $60. And if you buy this book on Amazon, I want to thank you, but I'll gift you a copy of this for free, okay? It's 300 pages, but it's actually 2 books in one, okay? The one book is the white covered side, and this is for the left brain learner. If you like to learn with charts and graphs and percentages and so forth, the numbers, this side is for you. There's 14 chapters, and you'll be blown away learning about strategic rollouts and how to accumulate, access, and transfer your money tax-free. How to create tax-free retirement income. Now, if you learn more by stories, you simply flip the book over to this one. This is about 100 pages, 12 chapters with 62 actual client stories. If you want to use your whole brain, your right brain and your left brain, then you can read the whole book. Now, here's how you can claim your free copy. You go to laserfund.com, L-A-S-E-R fund.com, or click on the link below. And I require a little skin in the game. You contribute a nominal amount towards the shipping and handling. I will cover the rest of that cost, and I will pay for the book. Now, I will fire out a hard copy to you via priority mail. But while you're in there claiming your free copy, if you like to listen and learn or watch and learn, there's those educational formats available for a nominal investment. You can also schedule to attend an educational webinar that's free. We do it every week, no cost, no obligation, to learn more. But here's what I want you to do. You can schedule an appointment while you're claiming your free copy. To talk to an IUL professional that I've trained and I oversee. These are the top 13 out of over 5,000 I've trained that I trust. They will show you a strategic rollout illustration based on your particular set of circumstances and illustrate how much money you can save in unnecessary tax and how you can dramatically increase your income. I don't care if you increase your income by 20%. Most of the time, we double people's retirement income, even triple and quadruple it, as many of these stories in the book and on this channel illustrate. So this is not about us or about me. This is about you and your brighter future. Get the taxes over and done with and reposition your money into the green bucket, the tax-free one, a property structured, max-funded IUL laser fund.